Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today you are in for a treat. We are going to go through the 18-year land cycle, how I see 2024 playing out based off the cycle, and then we'll also dig into more detail around key data to further explain my thoughts on this year and the coming few years. So, to give you a quick background, 2008 crash. At the time, my father's business was doing well the lead up into 2008. And then throughout the 2008 crash, his business did quite poorly financially. Also, a lot of people's super stocks got hit 50%. Commercial real estate over 50% got hit. Residential real estate probably 10 or 15%. It's quite resilient, the residential real estate market. So I couldn't quite understand how can the economy and businesses be doing well and then all of a sudden out of left field get hit with a big crash. So I started digging around as I couldn't understand why no one saw this coming. And I came across a few books. And so these books study the 18-year land cycle based off over 200 years of history. I suggest getting a copy and reading them. I, by no means, promoting them. They have just very well helped me to navigate my investments throughout the 18-year land cycle, which I will explain shortly. I'll start by reading Fred Harrison's book. It's easy enough read. Boom bust predicted in 2005 of the GFC. I will then read The Secret Life of Real Estate and Banking by Philip J. Anderson's work, which goes into a lot more detail. It's a harder read, but it's almost like a Bible. I've got it highlighted, um, scribbled on. I use it. I refer back to it throughout the cycle to best understand and best play my investments. I would then, so that book is published by Philip J. Anderson. He's also, Philip J. Anderson and Akil Patel also have a subscription platform, which I also subscribe to, Property Share Market Economics, which they also give you ongoing running commentary of the cycle. Yeah, so get onto that if you haven't already. And then also only recently, Akil Patel has published his book, The Secret Wealth Advantage. I would read that last after reading these two, as Akil's work complements both Fred Harrison and Phil J. Anderson's work on the 18-year land cycle. He then also goes into good detail around how to best play your investments in terms of real estate, stocks, commodities throughout the cycle. When to buy, when to hold, when to sell. So that then gave me a lot of clarity and understanding that mainstream media and commentators have really no idea. So if you're watching the news to get your updates on how the real estate market is going, I don't even really look at the news these days. If there's anything that I need to know about in the news, I'm sure I'll be aware, but I don't watch news really ever. I study cycles, study the markets, not through mainstream media news outlets because they don't have a clue what's actually really happening. So out of their work, they discovered, based off over 200 years of history, that there's an 18-year land cycle or real estate cycle. It consists of, on average, 18 to 20 years. And you can trace them back all the way back, specifically using the Dow Jones to get you a good visual. But it consists of 14 years of expansion and 4 years of downturn. And the 14 years of expansion is interrupted with a mid-cycle slowdown, which is I guess, recession. but it's not a significant recession like a GFC or a 91 recession we had to have, or the recession of in the 70s, which we'll go through in a minute. They are like the COVID recession, which we just had, where um, the economy is still strong in a good position, but it's just ready for a bit of a cool off. So we'll start with, I guess, the last three cycles to get us up to speed of where we are today in 2024. So um, the last major, I guess, in 1972, there was a boom in the late 60s, and then interest rates were rising as the economy was growing, and a lot of people were speculating. Building was starting to kick into gear. A lot of developers were building a lot of apartments for the first time, especially in Australia. And then there was the land-driven downturn into 1972. That then recovered out into 1975, and then there was a recovery, and the economy expanded up into 1981. Slowdown into the early 90s, and then there was a big land boom or property boom up into 1989 peak. We then went through the 91 recession we had to have, which most baby boomers would know about, who held property where interest rates got to 17% and nearly killed half the people who were over leveraged at the time. We then recovered out of 1991 into 93, 94, and then had a lead up mini boom up into peak of 2000 before the 2000 Olympic Games. We then had a slowdown, which was the dot-com bust, the famous dot-com bust from 2000 to 2002, where again, similar to COVID, stock markets, super took a 50% hit. Real estate really only had a bit of a slowdown, but nothing significant, 5 to 10%. And then we had the large land boom again from 2002 lead up into 2007, which most of you would be aware of, which was the peak prior to the 2008-9 GFC, which was the land-driven downturn, where interest rates were rising, inflation was rising, property prices were rising up to the peak. Speculation starts to kick into gear. Property prices are hitting all-time high after all-time high, and then interest rates get pushed too far as governments, the RBA, are reactive. They're not proactive. They'll push it too high, and then they'll bring the market down. It then resets, and then we recovered out of the GFC in 2011, 12, lead up into 2019, 2018, 2019. We had a bit of a, I guess, out of structure adjustment in 2019, where APRA stepped in and clamped down on lending, and there was a bit of a credit crunch. That was more or less out of the structure as they stepped in, but more or less we did have a significant, well, not a significant, but a good strong run between 2012 and 2018-19. We then went through COVID the last few years, which was the mid-cycle slowdown again. Property prices, as you're aware, didn't really get hit at all during 2020. Personally, I bought 4 or 5 properties as I knew this was the best time to buy. 2020, and then by 2021, we had already kicked into gear again, and we were almost away at the races. So now we are positioned on the yellow market, 2024. We have recovered out of COVID, and we're almost setting all new benchmark highs now. Pretty much regained all the losses through the last downturn, which was about 8 or 9%, 7 to 10%, depending on what market you look at. But they have pretty much all been regained and are now booming. So we are now position based off history, based off the work of Fred Harrison, Phil J. Anderson, Akil Patel, based off a lot of commodity cycles, stock market cycles, the real estate cycles, which we'll go into more detail. If you're still hanging around, we're going to go into more detail. So stay tuned. We are now positioned in the land boom, where we are going through the biggest boom or land boom in history. Every boom, every land boom dwarfs the one before. So the boom we are about to go through, or we're in the midst of now, is going to dwarf what was 2002 to 2007. And then the land-driven downturn will also dwarf the GFC because there's more debt, there's more credit, there's more lending, the economy's growing, the booms and the busts continue to outpace and outgrow the history. So now is a good time to prepare, be cautious with your investments, not overpay, don't be over leveraged. So we're going to have a good run up until 2026. And then, in my opinion, based off the history and the work that I've studied, interest rates will probably keep rising along with inflation, along with property prices until we hit the peak of the market where interest rates get pushed too far, yet again, based off history. And then we'll go through the next land-driven downturn where interest rates will then get dropped back to near zero. And then this would be obviously the best time to buy between 28 and 30. And then we'll carry on through the next 18-year land cycle. So to give you, I guess, I've pinpointed also other events of this land-driven downturn to give you a bit more overlay of the cycle. 2008, Lehman Brothers went bust, over-leveraged, and had too much exposure to the subprime mortgage space, hence why they went broke. The fourth largest investment bank in the United States had been in operations for, I think, over 100 years. It was pretty significant bankruptcy. So that was the land-driven downturn. The last land-driven downturn, 1991, Donald Trump was heavily leveraged with 3 or 4 casinos in Atlantic City. In the lead up to, so 1991 was the recession we had to have, or suppose it's a recession we had to have, but it was the land-driven downturn in the prior cycle to the 2008 land-driven downturn. The lead up to 89 peak, between the early 80s and the late 80s, Trump was printing money out of his casinos, making a lot of money. He was then leveraging the money out of that to buy more casinos. Typical real estate investment model. When the market topped out and then the market went through the 91 land-driven downturn into 92, 93, 94, 95. Trump was saying survive to 95 was one of his famous quotes at the time. He had to fold on all his casinos because the revenue pretty much went to zero. People obviously weren't spending money in his casinos when we're in a tough recession. Therefore, the revenues he was receiving from the casinos could not service the loan repayments for these assets. So he had to fold on them. That's another pinpoint moment where he thought he had a good, strong running business in the lead up to the peak. And then once reality hit, it flipped on his head. Same happened to Harry Triguboff in the 1972 land-driven downturn, which was the land-driven downturn prior to 91. Harry is the largest real estate developer in Australia. He's worth 20 or 30, 20, 25 billion. He was heavily leveraged with Citibank, US banks that were coming to Australia for the first time in the mid to late 60s. During the mid to late 60s, the bankers thought he was a genius. He was making all this money. And then the market turned into the land-driven downturn of 71, 72. And then the bankers thought that Harry was broke. Harry's classic fashion, the bankers wanted the money back out of Harry. And in his classic fashion, he decided to go and build more sites and basically said to the bankers that if you want to try and send me broke, I'll send you broke and I can give you back half-built construction sites. Um, but he eventually got through it and then vowed after that downturn to never rely on banks ever again. And to this day, he's a self-funded real estate developer and he doesn't have any debt. Quite amazing story. So yeah, just a bit of a disclaimer. This content is general nature and by no means can be taken as financial advice. I'm not a financial advisor. You will have to seek out your own independent advice before making any investment decisions. I operate as a buyer's agent, so I source investment grade property for property investors to help them on their journey to build property portfolios. If you are interested in such services, hit me up. I'll put links to my website, Instagram, Facebook, all the social media pages in the comments below. Happy to chat anytime to talk about your goals and our services. So now that we have gone through that, for the viewers that are still hanging around, what really makes me, I guess, confident and excited and optimistic of the market in the next few years, as we are in the midst of the land boom, I then overlay specific data and dates to see what happened in history and overlay the 18-year land cycle to show how the market could play out over 2024 and the lead up into 2026. So interest rates, yes, they've gone up significantly in the last couple of years or year or 2 years. They are still relatively low. So we're only 4.35%, just over 4%. So the boom, the last land boom in 2002, 2003, boom up into 2007, interest rates went up a good 12 or 13 times. We're still at 4%. So they went up to like 7.5%, even a bit higher, 7.8%. So I still believe interest rates are still going to keep rising because we're still low in real terms based off history. So we can even go back even further and show you how low we are. So there's still a lot of room to go for interest rates. And for those that say, well, if interest rates go up, that crashes the market, it'll eventually bring the market down, but not until the rate hiking cycle has completely topped out, which is there's a lot of work to go. And to show you the example, so these dwelling prices, this only goes back to 2012. So I actually dug out another report from CoreLogic, which shows what happened to property prices when interest rates went up in the last land boom of the last cycle, as this can be shown as an example of what could happen in this current land boom. So April 2003, units, houses, national. So this is on average. So they were, high twos, nearly 300,000. Boom up until 2007. So between 2002 to 2007, property prices went up. So did interest rates. So to explain how property prices can keep going up and do keep going up when interest rates rise during a rate rising session, is because banks start to earn higher profit margins because interest rates rise, they make higher margins. As they can make higher margins, like any commercial business, when a business starts to make more profits, they start to expand their work and take on more risk and take on more work. And for a bank, that is by expanding their loan book and start to loosen their lending and lend out more money into the market to earn higher returns. So previously, during, I guess, prior to COVID, where rates were low, lending policies were tighter because rates were lower and the margins were tighter. But now, as rates are rising, they'll earn higher profit margins. They will now be able to take on more risks by way of lower deposits. So, there's even 3% to 5% deposits you can get these days. Low doc loans, and this happened in the lead up to the GFC, where, especially in the States, you could have gone into any bank in America and basically not even prove you had a job and get a $500 to $1 million loan drawn up. That was loose lending. So as lending loosens, because banks are making more margin, they'll expand their loan books, they'll lend more credit into the market. That credit is then used by people to go and buy real estate, and property goes up when people have more money to spend. So if people have more money to spend on their real estate, then prices keep going. So um, next one. Also, for the next 2024, the dwelling approvals. So there are about 14,000 of dwelling approvals, still relatively low. So this is people, so developers and builders applying for a DA to build sites. So that they are low. Reason for the being low is because a lot of development sites still don't stack up because of the high cost of materials and labor. So until the market moves in terms of prices, that will then make their sites stack up. Then that will then spur on more development, dwelling approvals. So when approvals are low, there's less new construction being put onto the market or developed into the market. So there's a restriction on supply. And when there's a restriction of supply and a very high demand, net overseas migration. So Albo, he doesn't want to be voted out. So he's got his foot flat to the pedal, bringing in the most migrants in history, 700,000 overseas migrants, where historically the last few years are sub 500, but in the previous lead up to the GFC, it was around the 150 to 200,000 mark. So we've got record numbers of migrants coming in, and we've got low level of new dwelling approvals. So when there's a high demand and a low supply, prices go up. Next is the average wage, weekly wage is growing. So if you hear in the media that wages aren't rising, it's a crock of shit. We are now at 1,400 a week average weekly wage. So there's more money, more people making more money in the system. That'll ultimately also get filtered down to the benefit of land price. When people have more money to spend, they can borrow more credit and they can lend that into the market, use that credit to buy property in the market. That pushes prices up. Next is Australian unemployment rate, which is still tracking below 4%, the lowest since the 1970s. So there's plenty of jobs. If you want a job, you can get a job. If you want a second or third job, you can get it. There's plenty of work out there. So it would be an issue if unemployment was rising or high, but we've got the strongest unemployment rate seen since the early 70s. So very good for the economy, very good for property. Next is, so this is the amount of government spending, which is mind-boggling, but so it has increased to 132,000 million, which is $132 billion of spending per year that the government's doing. Infrastructure spend, government handouts, the dole payments, all this money is spent, which ultimately flows through to the benefit of land price. It is the law of economic rent, which we can probably discuss another time. And then on top of that, this is the money supply. So this is the government printing money, creating new money. This is why I guess famous people like Robert Kiyosaki says, don't work for money, work for assets. Assets create a cash flow. If you work for money, you will be working for money the rest of your life because the government is printing more money than you can earn. Therefore, it constantly increases inflation, it drives up asset values, and if you don't hedge your wealth by way of holding assets, hard assets, then you'll always be on the treadmill to try and to earn more money. So they have printed 460 billion in November alone. So they're printing, 460 billion a month. It's coming down, but it's tracking prior to COVID was around the 150 mark. It's spiked up, it's coming down, but who knows how low they will do it. It's almost like a shot of adrenaline. Printing money, it keeps the economy moving, keeps it stimulated to keep the money supply active. So it will be very hard for the government to ease off it. So this is another reason why I'm very optimistic of the property market moving forward, because the amount of money that gets pumped into the market will ultimately increase asset values and devalue the debt that you use to buy the properties. So thanks for watching. Catch you next time. Hit us up anytime if you want to chat about your property investment goals and our services we can provide. Cheers.